Welcome to the Brokers Lounge with Eddie and Carlo. Disclaimer: the information contained in this podcast is general in nature and does not take into account your personal circumstances. Please head to the show notes if you want to book a free call to discuss your personal situation.
Hi everyone, and welcome to another episode of the Brokers Lounge. My name's Carlo, obviously, and I'm joined by my colleague Eddie again. How's it going, Eddie?
Very good, Carlo. Very good. How you been?
I'm doing okay.
Did you enjoy your week off?
I didn't have a week off. I just had the day off. No, it was very good. Celebrating my son's 21st birthday, so had a bit of family down from Adelaide, which is nice. So always good to celebrate with the family. That's
Happy
for sure.
birthday.
Thank you. I'm feeling very old. That's for sure. So. But I guess interesting topic this week. Nice one for probably our more younger listeners out there. We're essentially going to be talking about first home buyers and the various government schemes and grants that are available in the market at the moment. There are a few that are available. There's some that have been around for a little while now. But in particular, we're going to talk about the first home guarantee scheme, probably the most popular out of all of them. There's another scheme called the Regional First Home Buyer Scheme as well, which is obviously very self-explanatory. And then there's another scheme called the Family Home Guarantee Scheme. So that's another good one for the more single parents out there with children looking to buy a home as well. And then we'll finish off touching on the First Homeowners Grant, which is the one that's been around for a lot longer. And we'll also talk about the Shared Equity Scheme, which is probably one of the least, I would say, popular out of the schemes, but obviously still available. Another option for our listeners to use if they're looking to buy their first home. So, but I guess essentially, the First Homeowners Scheme was designed to obviously assist those first home buyers getting into the market, purely because if they don't have enough deposit, they essentially got put in a position where they're having to borrow a lot more, which pushes them above the bank's maximum limit of, say, an 80% loan to value ratio, essentially making them having to pay lenders' mortgage insurance. So the government brought out these schemes to help, those first home buyers get into the market a little bit earlier by way of guaranteeing that bit that's missing. So if they're saving, say, 5% or 10%, instead of paying mortgage insurance because they're still over the 80% mark, the government will chip in the remaining percentage to bring it back up to the 80% mark. So
yes, and just to be very clear, by chipping in, they don't actually contribute anything. They just guarantee that difference.
Correct. Yep.
Just to ensure you don't pay any lender's mortgage insurance.
Yep.
So probably this is the biggest one we work with and we've dealt with over the last couple of years. I don't know how long it's been around.
Yeah, probably about 2 or 3 years now.
Yeah,
so.
But we've done a fair bit around the first home guarantee scheme, and it really helps a lot of people get into the market a lot sooner.
Yeah.
I guess the benefits of it, obviously, like you mentioned, not paying that lender's mortgage insurance, which means you can get into the market with a 5% deposit, which is the deposit is usually the biggest barrier that does not allow people getting into the market sooner. So this helps you get into the market with just a 5% deposit without paying any lender's mortgage insurance. Also, the rates you will be getting are similar to your 80 and sub 80% LVR, so you're not being disadvantaged in any way.
That's probably the big one, isn't it? Because typically if you're in a position where you're not a first home buyer, for argument's sake, and you're having to pay lender's mortgage insurance because you've gone over the 80% mark, you're not only paying that premium, but you're also paying a much higher interest rate as well.
Absolutely.
So the banks have been pretty good in saying, well, the government's guaranteeing the rest of it for you, but we're going to treat you like someone else who's got the 20% equity anyway. So that's pretty good.
100%. And also one important thing of this, it's where people confuse the equity scheme with the first home guarantee scheme is the equity scheme, the government actually owns part of the property. In this one, the government has no ownership in the property.
Yep.
And as soon as that LVR goes down to 80%, that guarantee is automatically withdrawn and you just go your own way.
Yeah.
But obviously, there's a few things that you need to be mindful about.
Yeah.
And first one would be serviceability. So you need to demonstrate serviceability for the full amount you are borrowing. So it does
that's important too, isn't it? Because I know I've had customers in the past where they go, well, if the government's guaranteeing that extra amount, does that mean I only have to demonstrate the ability to repay, 80%. my percentage of it? And it's like, well, no, that's not actually the case.
100%. So you need to be able to demonstrate serviceability for the full amount you're borrowing. You need to actually do repayments on the full amount you're borrowing. So you really need to be careful about this part or mindful about it. Obviously, there's certain criteria that you need to meet to be eligible for it. So probably the first one, there's an income cap on how much can you be earning to be eligible for the first home guarantee scheme. If you're a single person, that income needs to be $125,000 per annum. Combined incomes, is it
200,000?
200,000.
Yes,
200,000. So if you're you and your partner applying for it, your annual income combined needs to be 200,000 per annum. And the way to confirm this is by getting your last year notice of assessment or group certificate to show your annual income over the last financial year.
Yeah, and that's probably one of the big things as well, where a lot of people don't or aren't actually aware of it, is that when you go to apply for a loan using these schemes here, come 1 July, you have to actually pretty much get your last year's tax return done, submit it to the ATO, get your notice of assessment. So typically there's a bit of a window where you could submit an application and whilst you're waiting for your tax return to be completed, but it's very short. So, this time of the year, our clients have to have had their FY24 notice of assessment ready to go to hand over to us to be able to verify that, they're within that income cap.
Absolutely. And I guess now we're in October. It's a perfect time to take advantage of these schemes because you're at a stage where you should have done your tax returns or you're about to, and you've got 7-8 months until the financial year to end. So you've got a good amount of time to get the pre-approval done, find the property and settle. And one thing that's very important, even if this year your income is higher than the $125,000, as long as you can show that your last financial year is within the limit, then you can still be eligible for the guarantee.
Yeah.
So this is very important. Another criteria, obviously, you need to be a first-time buyer or any of the applicants. That both of you need to be first-time buyers. You both need to be either citizens or permanent residents. Yeah. So this is very important. Both of you need to be either citizens or permanent residents.
Probably one that comes up more often than not, in where they may not be an Australian citizen, but they're on, say, a temporary residency visa, and it's unfortunate that doesn't work. So both of them, not just one, have to be permanent residents. So.
Yeah. As a New Zealand citizen, you are eligible for these grants as well. So
that's all right. Oh, there you go. I've learned something today as well. Thank you.
Yeah.
Didn't know that one.
No worries. You're welcome. And obviously, there's generic conditions. Obviously, it has to be a normal property, whatever that means. But obviously, you can't go out buy a 50-acre property and use that scheme. So it has to be for the sole purpose of helping you getting your foot in the market and buying your first property to live in. So you have to live in the property. It can't be an investment property. There's the income restriction. Is there any age restriction?
Typically, minimum age is 18.
Oh yeah, minimum, but there's no maximum.
No.
Okay.
I don't think we'll probably ever see someone in their 60s
first-time buyer
being a first-time buyer. But hey, you never know. It's possible.
I've never had that yet. I guess this pretty much sums the eligibility criteria and what the first home guarantee scheme is.
Probably the one thing that we haven't touched on, which is where a lot of people are probably in this current environment are more interested in, is the property price caps as well, because each state has a price cap. There's typically a cap put in place for the major cities, and then anything outside of the major cities or regional centres as such. So, for argument's sake, what's Victoria now set up?
7 or 8? Like It's super confusing, and
Yeah.
every state has got a different set of rules in terms of caps and incomes and the price. So
Yeah, 800,000 for Victoria now. So
it's easy to actually check them on the website. It shows you each property and each city what the caps are. So this way it's just straightforward, because actually I don't remember every city what the caps are.
Yeah, exactly right. And we're in a position where we're dealing with clients from all around Australia nowadays as well, not just here in Victoria. So, but yeah, there's the website links we're going to put on our podcast show notes at the end of this as well. So people will be able to go to those websites, have a look.
Yep.
You can have a look at the eligibility criteria. You can download a tool that'll ask you all the questions and it'll tell you very quickly whether you're eligible or not, which 100%. Is a great way. Make sure it fits within the property price caps as well. So, and this is probably that property price cap is where we see the difference between people using the first home guarantee scheme versus that shared equity scheme. Because the shared equity scheme allows people to purchase a little bit more than this 800,000, say in Victoria. I think it goes up to about 950.
New South Wales. Sydney.
In Victoria, so they can purchase a little bit higher. Correct. So that's when we typically see clients go, well, I'm a little bit outside of the price cap for the first home guarantee scheme. So how do I still utilise the government's way of being able to guarantee it? And they go via that shared equity scheme.
Yes,
and such. So
that's absolutely right, and that's why it's a case by case, because even every guarantee and every scheme out there has got different caps. So it gets a bit confusing. Like if you're getting few schemes and guarantees at the same time, you need to make sure you're eligible for all of them and you hit the caps for all of them to benefit from all of them. So that's why it's a case by case and scenario by scenario.
Yeah. And the application process is pretty good too. It's not really that much different from what we'd normally take our clients through, from obtaining all the documentation, proving your income, your savings.
Genuine savings are very important.
Yeah, genuine savings. So
the 5%.
Typically aim for 3 months worth of genuine savings to be able to demonstrate that you haven't just come into a windfall of money, and so you still need to be able to demonstrate that. And the good thing is with the approvals as well, because and what we find more often than not is people are coming to us and saying, I want to go and buy a property. It's our first home. We want to utilise the scheme, but we're too scared to go out there and buy anything until we've got some type of pre-approval. The good thing is with these schemes, they do allow pre-approvals as well. So the banks will go through the normal process, assess it as they would a normal pre-approval. They'll also guarantee you a spot, so they'll reserve a spot within the scheme. So it's worthwhile to note as well with a first home guarantee scheme, every year there's a certain number of places that are available. I think at the moment it's 35,000 every year. So like you were saying before, we're in the month of October now, so it's probably a good time because there's only been a few months worth of people utilising the scheme. So there's still obviously plenty of places left available, which is ideal as well. But if you're getting towards the back end of the financial year, say you're approaching a bank in May, you'd want to make sure that there are actual
unless you've got something ready to go, then it's recommended to wait until the new financial year. Yeah,
exactly right. So, sorry, go.
No, keep going.
I was going to say, because where a lot of people need to also understand as well, that in terms of the obligations of clients, there is no difference. You're still responsible for making all the repayments on the loan, for the whole duration of it. That guarantee like you said, stays in place until circumstances change. And that circumstance will typically be that you've reduced the loan balance enough to bring it within that 80%, where you potentially then refinance it, whatever you might want to do, and remove that guarantee from the scheme. So,
all right, that should cover most of the first home guarantee scheme.
Yeah, and I think the regional one is, when you look at the criteria, it's almost identical.
It is.
Probably the only difference is obviously those price caps. And secondly, that you need to have lived in that regional area for a minimum of 12 months. So they're really the only two main things that are going to be different. Everything else in terms of income for an individual or a couple, age, residency, they're all exactly the same. So quite easy to remember from that point of view. But I think the next one is obviously the family guarantee scheme. And I've been fortunate that I've been able to help out a couple of clients in those circumstances where I've had a single mum recently divorced. with a child, and she's obviously looking after the child, looking to get into another home. And the good thing is it doesn't actually need to be your first home as well. So you can utilise this scheme for your second, third home, whatever it might be. But once again, it gives you the ability to, if you don't have enough of a deposit, to utilise this scheme. The main difference is that with the first home guarantee scheme, that minimum amount of savings is 5%. With a family home guarantee scheme, it's only 2%, which is great. We see a lot of people, who have gone through divorce, and it's like, what do I do?
Lost the savings.
Exactly right.
They've got the income.
So it's their time to sort of rebuild, and they want to get back into the market. They've got enough income to be able to service a loan, but not maybe potentially enough savings to actually put into it as a deposit. So another great way to do it. Key thing is that this one here, you can't be separated. You have to actually be divorced. To be eligible for the scheme.
And you have to have an dependent child.
Correct. Yeah.
So you need to have a dependent child to be eligible for it. It's not just a matter of being divorced. You need to have that responsibility of taking care of a child to be able to benefit from the family guarantee scheme. So like we said earlier, it can be a bit confusing or overwhelming. So reach out to us or a broker, or check your website to make sure that you're eligible for those schemes. But I guess the biggest difference with this one is that you don't need to be a first-time buyer.
Mm-hmm.
This is a key part. But you can't own another property. So you need to be buying a property, but you don't need to be a first-time buyer. And the 2% deposit, which is great.
Yeah.
It makes you wonder if it's worth getting divorced.
I think I'll leave that one right alone. Thanks, Eddie. I think the next one, the best one to move on to now, would be the First Home Owners Grant.
Yep.
Which is the one that's been around probably for the longest.
Yes.
Having said that, it's probably the one that doesn't get used as much, and that's pretty much because it only relates to new homes. So, Eddie, maybe if you want to just give our listeners a bit of an idea as to what the First Home Owner Grant entails, roughly what the dollar values look like as well.
Yeah.
They do vary from state to state.
They do. Yeah, they do. So it's basically, buying a either newly built property, which has never been lived in before, or building your own property. And if you are a first-time buyer, you are building your property or buying a brand new property, then there's grants available with each state. So I've just got some notes here because it's so hard to remember. So we've got in New South Wales, they pay up to $10,000 for a new home. Obviously, you need to be a first-time buyer, 18 or older, and the property must be, if you're buying an already newly built property, it has to be up to $600,000. If you're building your own property, you can go up to $750,000, and you have to live in the property after for a minimum of 6 months. So if you tick those boxes, you get paid $10,000. Victoria, pretty much the same, $10,000. If you go regional, they pay you $20,000. The cap price is $750,000, and you have to live in the property for 12 months. Queensland, they pay you $15,000 for a new home, and caps at $750,000, and you have to live in it for 12 months. So we've got South Australia, they pay $15,000, Western Australia $10,000, Tasmania they pay you $30,000 if you build your property. So that's actually decent.
I was say $30,000 in Tasmania might cover a fair chunk of it as well.
I think so. It's not very cheap. So yeah, I've done probably a few because I've done a lot more when construction was booming. In the last couple of years, construction has died off. So there's very few construction applications in the pipeline. But really, it can come in really handy, getting that $10,000 back. Now, one thing to be mindful about is you can't use that $10,000 as part of your savings or contributions towards the construction cost or the land purchase. So you have to pay your deposits, and then after the slab first stage basically is done, that's when you receive the $10,000. So you really need to get the process underway and tick all the criteria there to be able to be eligible for the First Home Owner Grant.
Yeah, and the good thing is that you can obviously lodge your application directly with the relevant revenue office, state revenue office in each of the states or territories, or you can actually put it as part of the home loan application process, so we can actually take care of that for our clients as well. Worthwhile, obviously, going into a little bit more detail. We mentioned it earlier on about the shared equity scheme and what that entails. But once again, it's just another government scheme that was introduced to further help home buyers enter the property market. Eddie, you touched on it earlier on. Essentially, the difference is with the first home guarantee scheme, you pretty much retain 100% ownership of the actual property itself. With the shared equity scheme, it pretty much is how it sounds. The government actually takes a relevant stake in your actual property itself. So, buyers can contribute as little as 5%, and the government will chip in via a guarantee. I'll preface that again, not actual cash, but via a guarantee that remaining portion. But that bit that they do guarantee is they actually own that portion of your property. So it does limit, or sort of does create a few more conditions when you want to go about selling the property down the track. You need to obviously seek, I think, approval from the government to actually release their guarantee. They want to make sure that the debt's obviously far enough down that they can be released. If not, then obviously it has to be repaid back. So, but once again, obviously suited to first home buyers only. The income limits are very similar or almost identical to the other schemes in terms of $125,000 for individuals or $200,000 for couples. The property value caps no more than $950,000. So that's obviously, as I mentioned earlier on, that's where we see the difference between those that are going for the first home guarantee scheme versus their shared equity scheme. And obviously age requirements, 18 years of age. We typically don't see anyone under the age of 18 looking to purchase a property and utilise that scheme. Repayments, no difference there. Same as any other loan. You're still responsible for the whole amount. The main conditions that probably people need to be wary of is that you must occupy that home as your principal place of residence for at least 12 months.
Yes.
And the other thing as well, property maintenance-wise, the government's not going to sit there and go, yeah, we'll look after your property for you because we own part of it. No, it's still your responsibility. And I think from memory, you have to actually declare each year that, the property has been kept and maintained as well. So, it's a good scheme for those who are wanting to go above those property price caps. But it does have a few little extra layers of implications built in there.
Yes.
But it's for some people, it's not for everyone, that's for sure. So
yeah, absolutely. And to be fair, I just think there's a bit of disconnection in terms of caps on property prices and the caps on incomes and the borrowing capacity. So really, realistically speaking, if you're a single person on 125,000, the cap is 950, but you can't actually afford borrowing a loan up to afford a 950 purchase price. So that's where these caps are really not very realistic. And I feel like the government didn't want to make it ideal or easy just to keep the property market a bit under control.
Yeah.
But it's definitely not very aligned in terms of borrowing capacity and caps. So
yeah, I think they increased it only 12 months ago or 24 months ago when the property market was still chugging along quite nicely. And I think maybe now the property market, especially in New South Wales and Victoria, is starting to cool off a little bit. They may well reassess those property cap limits and see whether they're still realistic. Because like you said, when you do the numbers, it's not overly realistic in terms of, clients wanting to go up to those levels. So,
like on a 125,000, you'd probably be able to afford a $500,000 mortgage.
Yeah, probably more for the couples. I think that would probably where they get towards that. So.
Yes, and I think what ties it all together is obviously the stamp duty.
Yeah,
first home stamp duty waiver, and this is very common because every first home buyer tries to take advantage of at least the stamp duty waiver. But the caps are obviously on the property purchase prices, and this is where as well it's not very aligned with what's out there in the market. So in Victoria, $600,000 to benefit 100% of a full waiver, and then the concession kicks in after that up till $750. But realistically, you don't benefit anything over $700,000.
Yeah,
and like good luck finding something for 600,000 or less, unless you want to buy an apartment.
Yeah,
or
correct.
a
Yep.
1-bedroom townhouse somewhere.
Yep.
So that's where I think it's more pushing towards first-time buyers, just to get your foot in the market. But I've dealt with a lot of first-time buyers that they prefer to go straight to buying a nice property that they want to spend 5 to 10 years in and just not benefit from those waivers. So
Yeah, but for those, and I've had one recently where they were lucky enough that they got in right on that pretty much 600, I think between 600 and 650, where they were able to utilise the scheme, the first home guarantee scheme, so they didn't have to pay any LMI or lender's mortgage insurance, but also had that stamp duty concession as well. I think they paid only a few $1,000s because between that 650 wasn't too much at all. So it does work for some.
It does.
Just when you're in capital cities like Melbourne and Sydney, where prices are going through the roof, and it doesn't always work. That's for sure.
Yeah, if you manage to build something, good luck. But if you manage to build something for $600,000, you can pretty much benefit from the first home guarantee scheme, where you pay 5% with no LMI.
Mm-hmm.
You benefit from the full stamp duty waiver, and then you get $10,000 when you start construction. So basically, you're out of pocket by $20,000 by utilising all 3 schemes, and you've got yourself a property. So it can be really, really good to get you in the market, but obviously it's not always the case, and it's not always preferred by certain people. So it comes down to your preferences. Where do you want to live, what you're looking to buy, and what's your plan. So that's why it's very important to have the discussion, run the numbers, and see what works for you.
Yeah, don't put it all on your own shoulders as well to try and get all the right answers. This is why, talking to a broker who's got all this knowledge at their fingertips will help guide you through what's the best way to structure it, so that you can maximise your ability to purchase a property. Utilise the government if you're able to utilise it. Why not? Why hand over $1,000 extra in stamp duty or mortgage insurance 100%. If you don't need to? So, but yeah, there's lots of good information at everyone's fingertips. Like I said, we'll share the details of the government websites as well.
Yeah.
So I think it's important for people to be able to have a look at that and get a better understanding as to what the various schemes look like. But
absolutely. So yeah, by all means, try to utilise those schemes and whatever the government is offering at the moment, because you don't know how long that's going to last. And if you're trying to time the market, then we do not recommend it, because you don't know how the market's going to move, what's going to change, what's going to happen. Just work by what's your current situation. Are you renting? How much you're paying? If you buy something for that much, how much you're going to be paying? Weigh it out. Is it better to get yourself a property? I obviously always say yes, because that would be, especially if you're in your 20s, like 10 years down the line, you've built yourself a decent equity, and then you can use that equity to buy your next property. So just get yourself in there, have a foot in the market, and then you never know what's going to happen.
The old saying, time in the market, not trying to time the market. I have that many people say to me, Carlo, do you think now's a good time to get in? I'm going, it's always a good time to get in. Just get in.
Just get in.
Just get in, and let the rest of it work its magic.
Yeah, that's it. Especially if you've got a secure job, your income's not going anywhere, by all means, just give it a shot.
Yeah, exactly.
I guess that covers quite a bit. There's a lot of information in there which I don't expect anyone to memorise them, so that's why I utilise the website, or reach out if you have any questions. Otherwise, we'll call it a day. Thanks for listening or watching. Please don't forget to subscribe and leave us a good review, and hopefully we'll see you all soon. Take care.
See you later, everyone. Bye-bye.